Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, July 5th, and then we'll see how things look for Thursday, July 6th. Didn't really see that much of a change technically. We're working off a little bit of the overbought condition. We had a slight down day, and it was more negative than positive overall, but we ended up not closing down all that much. But the positive signs that we're seeing are still there, and so far, we can evaluate this as more of a pullback. Now, we have some big economic reports coming out on Thursday, and especially on Friday, and that could change the overall climate. So let's go back and talk about what happened. Right at the open, we did have a lower open. The futures were negative. Prices dropped to S2 at 44.37. Then they bounced back up to S1 at 44.46. We got up to the daily pivot at 44.51, but we did not get back to the unchanged level, which is that built-in support or resistance level. As the day went on, prices fell back below S1, but we did not reach S2 before bouncing back a little bit at the close to close right about at S1. We were down 0.2%. And volume is below average. This is still considered to be a holiday week. A lot of people will be taking some time off. They may come back later in the week to react to some of the different economic reports that are coming out. But now we're starting to head into the parts of summer where people are taking vacations. The technicals are still positive overall. Short term, we still have a lot of overbought indications. Intermediate term, some indications, but we're working some of those off. Long term, we're still hanging in there. The inflation and interest rate scenario is still what the market's fixated on, and now we're seeing what potentially could be a little bit of a shift. At the end of last week, the market was more confident that maybe we're not having all these growth problems after all. We're not too hot, we're not too cold, we're just about right. Well, some international reports came out economically that I'll talk about, and they were weaker than expected. And so now maybe we're shifting back over to bad news is bad news. We're also keeping an eye on what's going on in Russia and the neighboring countries around Russia, just to see if any of that escalates and has an impact on the market. What are some comments that we can make? The concerns are developing now about global growth slowing down because we had weaker than expected reports that came out from China as well as in the Eurozone. The U.S. is looking to restrict China's access to cloud computing. That could have an impact on the tech sector. China said that foreign entities will have to request permission to export gallium. Well, what's that? It's used in semiconductors, and germanium, which, no, it doesn't come from Germany. This is used to produce fiber optics as well as night vision goggles. China produces about 60% of the world's germanium and about 80% of the gallium. The FOMC meeting minutes, which came out, didn't really have any surprises. The market didn't react all that much to that. Small caps were weak on the day. Now we're seeing a little bit of a contradiction here. The Russell 2000 index has generated a golden cross, but the S&P small cap index, it has not. And those two moving averages are still far apart, and I'll show you those charts. On a short-term basis, we still have the 20-period exponential moving average, the Williams %R, the CCI 14 and 20, the stochastics, the standard deviations chart, the Erin, and the PMO study are still extreme positive. Intermediate term, we actually added one, the CMB composite. We're keeping an eye on our oscillators, the Sean trend meter, and then the rate of change going back 200 periods. The dollar was up and interest rates were up, so both of these added a little bit more of a headwind to stock prices going higher. We still have all of the yield curves that remain inverted. Sentiment is still extreme positive. It came in at 80, where last time it came in at 79. Our trend is still positive, but the green line continues to come down, even though it's on top. But the ADX is still above its moving average, and both of them are above 20. I've switched our bias to mixed just because of the down day, but I'm keeping our momentum at positive for right now. The economic reports that came out, we had factory orders up 0.3% month over month. They expected it to be double that at being up 0.6%. Last time it came in up 0.3%. If you take out transportation, we were down 0.5% month over month. And the last time we had this report, we were down 0.6%. Shipments of manufactured goods were up 0.3% month over month. The last time they were down 0.6%. Now we saw a little bit of a shift in the economic reports. Some of them that were supposed to come out on Wednesday will actually be coming out on Thursday, and I'll hit that later on in the video. Here are some economic reports that did come out showing factory orders where we are declining and we're actually starting to go negative. Another chart that goes hand in hand with this is durable goods orders, which are seeing an increase. Non-durable goods orders are continuing to decrease. And non-defense capital goods orders, when you take out aircraft, they're also still positive. Some IsabelNet.com blog charts. Here we have the ISM Manufacturing Index. That was a report that came out on Monday where the gold line shows a continuation of a decline, and this is not necessarily good for the economy, where the purple line, which is the S&P, it is really starting to go back up. So we're seeing a real disconnect between these two. We're hearing a lot of talk right now saying that, well, it's just a small group of stocks that are really responsible for the market going higher. Well, if you look at it over a period of time, it's that way most of the time. It says that 10 stocks typically account for 32% of the S&P 500's return each year, and this goes back to 1995. The lighter blue line here is the median. And yeah, it's higher than usual. There's nothing to debate that. But there's been other times when we've seen really good advances in the S&P, and it's only been led by a small number of stocks. Then we look at July brings fireworks and bulls. Here's a square around July. If we go back to 1950, this is the gains that we've been seeing. The past 20 years is the blue line. The past 10 years is the green line. And then we're still positive in the pre-election year, which is what we're in right now. Even though it's lower than what it has been in the past, it's still positive. Then these are S&P 500 announced buybacks. The light blue line here just shows that they still remain strong. And then we can also compare that to other years. The technical overbought oversold composite is still getting quite high. We're at 91.2. Again, there's two ways to look at this chart. That we are extreme positive and due for a pullback, or the longer we can stay up, especially above 75, the more solid momentum we can see. Then we look at year-to-date inflows in the money market funds. They continue to go up. This is a chart that was pretty much the same as what I showed a couple days ago. When we had all of the stimulus coming into the market, that's still playing a role here and having a real direct impact on GDP. Then we look at risky versus safe asset flows. Folks are getting a little more risky now as they see the markets going up. Looking at our charts, here's the intraday chart where we gapped lower. The reason why the R levels and S levels are so close to each other is because on Monday the range was so small, so it didn't take us that much to get to these levels. We came down to S2 and that set the low for the day. We bounced up off of that. We came back above S1. We got up to the pivot. We never hit the unchanged level. Then we just drifted lower kind of between the pivot and S1. We saw some weakness come back in. We never got back down to S2 before rebounding, coming back up to the daily pivot, and then closing down at S1. Here's the intraday chart where we saw a little bit of strength in the overnight session. This other area is because we were closed for the holiday. Then when Europe opened, they were much weaker, and this is when the futures started to look more negative. But we turned a bit more positive as the market opened, but we never did go positive, and we're trailing off just slightly in the initial overnight session. So on a closing basis, growth was down, but it wasn't as down as much as value for the large caps. It was down a little bit less for the mid caps as well as the small caps. So even though everything was down, growth outperformed value. Here's the intraday chart where the red line is coming down below the blue line. The red line is value where the blue line is growth. And here's the value to growth ratio where we actually went positive near the end of the day. That could be a little bit positive going forward. The skew index, we're keeping an eye on that. We're not into this extreme positive reading at least yet, but we're starting to go back up. That is the market anticipating some kind of a big move. And as I usually say, we don't know if that's going to be to the upside or the downside, where you can point out times when both have ended up happening. Looking at our one fear chart, we did tick back up slightly, but we're continuing to decline. Our other fear gauge continues to decline. Then folks are still favoring a risk-on posture, which means they favor stocks over bonds. Looking at sentiment, the Ulcer Index was pretty much flat, showing there's not an awful lot of fear. The VIX turned up just a little bit with the line chart as well as the bar chart. And volatility of the VIX is picking up just slightly. That may be happening ahead of the employment situation report. This is the chart that we're keeping an eye on. We're continuing to go up with the VIX to S&P 500 correlation, but we're not at this dashed line, at least yet. The equity put call ratio really hasn't been moving all that much. It declined just a little bit overall. And the equity put-call ratio based on the longer moving average continues to decline, which is positive. Our advanced decline line studies. With the down day, we saw a little bit of a turn down with price and volume. The new highs still continue to outnumber the new lows, but we're pretty much flat with our 5-period moving average and pretty much flat now with our 10-period moving average. The advanced decline ratio did decline, but continues to be above zero. Accumulation distribution is still looking positive. And then looking at the cumulative advanced decline line, we ticked back down after we had been showing some improvement. Our regular advanced decline line also ticked down slightly. But we're still above this upward sloping trend line with the other advanced decline line for the NYSE that we follow. Common stock also saw a little bit of a pullback based on price and volume. Then looking at the broad range, the NYSE did turn down slightly, as did the S&P, the mid caps, and the small caps, but all of these indexes still remain above the moving average. Keeping an eye on our trend, the green line is still on top, but it is declining. The ADX is above its moving average and advancing, so we would still default to the positive, but we want to see this green line turn and go back up. Shorter term, we're also seeing a decline with the green line, and the ADX continues to go higher, and actually on a short-term basis is still looking a little extreme positive. Volume continues to drop off. Here's our daily chart. Nothing really changing as of yet as the market pulled back slightly. Volume did pick up from Monday, but is still well below average. The 20-period exponential moving average ticked down slightly, but is still extreme positive. We turned down a little bit with the 50 and 200-day exponential moving averages. The Williams percent R is declining, but still extreme positive. The CCI 14 also still extreme positive, but declining, as well as the CCI 20. The stochastics turning down a little bit in the short term, but still extreme, still advancing in the intermediate term and looking extreme positive and turning back up in the long term. Now, since there's a lot of new subscribers, please understand that short, intermediate, and long term take on a little bit of a different meaning here. This is a further subdivision of the short-term time frame. So this is short term, intermediate short term, and long short term. The force index declined a little bit, but continues to be positive. Looking at our intermediate charts, we ticked down with the balance of power, but we're still above the dashed line. Here's the CMB composite, which is starting to give us an extreme positive reading. The go-no-go system remains positive with the darker blue bars. We're still at the highest high part of this indicator, showing good momentum. The TTM squeeze switched back a little bit more negative. We turned to a lighter shade of blue on Monday. Well, now we switch back to a darker shade of blue. The standard deviations chart, we're still hanging out in the third standard deviation area. The PPO study still remains positive, but ticking down slightly in the short term. The Erin indicator declined slightly, but is still extreme positive. The S&P McClellan oscillator, after being extreme positive, has now dropped back. And our summation index based on price and volume continued to advance. The NYSE McClellan oscillator also declined, but is still above zero. The summation index based on price and volume continued to show improvement. The Swenlin trading oscillator ticked down based on price and volume, but are still positive. The PMO continues to be positive. We're turning higher based on price as well as volume. The PMOs that are rising after being extreme positive have now dropped back down. However, the buy signals are just barely extreme positive, and we're showing improvement with the PMOs that are above zero. The Elder Impulse system for the S&P remains positive with a green bar. The parabolic SAR system also has the dots underneath, so that is positive. The slope indicator is trying to turn back up, but has not crossed over positive yet. However, the MACD is looking a little bit more positive, even though it ticked down slightly on Wednesday. Looking at all of our oscillators with the slope and the TSI, these are our short-term oscillators. They're trying to show some improvement. The MACD is also trying to show some improvement, as is the PMO and the PPO. Our longer-term oscillators, the TRIX and the KST, continue to be flat. The Sean trend meter is still extreme positive, but it's coming down slightly. The BPI still shows some strength internally, and we're getting up to this extreme positive reading, but right now this is showing that there's good momentum inside the S&P. The NYSE bullish percent index also showed some improvement. The Chaikin money flow continues to be positive. The Chaikin oscillator is also positive. The money flow index did decline, but is still above 50. The ultimate oscillator is above 50 and advancing. The vortex turned down a little bit with the green line and up with the red line, but we're still positive. The RSI based on 14 periods is starting to roll over a little bit. Based on 9 periods, we're extreme positive and starting to come down. On balance volume declined but is still positive. Looking at the 200-day moving average study for the S&P 500, we came down just a little bit. We also ticked down slightly with the 50-period moving average. And then another look at this same chart shows a little bit of a decline in Wednesday's session. I don't have any Fibonacci and line studies right now because we're far away from all of those lines, so I'll keep an eye on them, and if they start to show us something, I'll bring them back. Our different charts, the Heiken Ashi still remains positive, as does the Kagi chart. The Renko chart redrew a little bit, but is still positive, and the 3-line break also continues to be positive. Looking at our different indexes, we turned down a little bit with the equal weight index, and it continues to underperform the S&P. The equal weight index ticked up just a little bit compared to the S&P 500, showing a little bit more broader participation. This is the chart that we're kind of keeping an eye on right now. We came right up to this previous high with the transports, and we're starting to turn back down. Is this going to provide overhead resistance, or are we going to be able to break through this and continue to go higher? We saw a little bit of improvement with the utilities. They were able to break above this downward sloping trend line. The transports ticked down just slightly but continue to show some improvement when we look at the transports to S&P 500 ratio, and the correlation between the two is showing that it is getting stronger. The transports are starting to come right back up to about where the Dow is now. Then our discretionary and staples study, we ticked down a little bit with discretionary, also with the staples. Overall, the ratio declined slightly but continues to be in an uptrend, showing that discretionary is outperforming staples. The Dow is still hanging in there even though it was down just a little bit, but the Elder Impulse system has changed back to neutral. The Nasdaq still has this overhead resistance, which also equates to a 61.8% retracement level. Can we break above that, or is this going to present a problem where we continue to fall? Here is the Fibonacci chart showing the 61.8% retracement level. Then we're also seeing internal weakness when we look at the cumulative new highs and new lows for the Nasdaq, and the indicator was just barely positive on Wednesday. This is another thing we're watching is a previous high for the Nasdaq 100. We're coming right up to this level and having trouble breaking through it right now. Are we going to turn and go back down, or will we get some more power behind the buyers and shoot us above this previous high? The Qs remain positive for the Elder's Impulse system. The Nasdaq 100 BPI continues to show some improvement after giving us a sell signal last week. It looks like this could be negated. Here's where I'm talking about with the small caps. Notice the 50 and 200 period moving averages, and they're quite far apart from each other. But if you look at the Russell 2000 index, we've seen a golden cross here. The RSI is still above 50, although it declined, and the MACD is trying to turn more positive, but is now pretty much flat. The Elder Impulse system for the small caps has switched to neutral, and the small caps continue to underperform the S&P, but we're still in an overall uptrend when we compare small cap growth to small cap value, even though it did decline. The mid caps also had a decline, but are hanging in there fairly well. But we switched back to being neutral for the Elder Impulse system. But overall, when we compare growth to value, we're still in an uptrend, and we actually ticked up a little bit with the mid caps. The S&P is still outperforming bonds, suggesting that we may enter a soft landing, meaning no recession, even though we're seeing economic slowdown. Keeping an eye on the financial sector, we were up a little bit, and we're back above the 200-day moving average. The financials were pretty much flat compared to the S&P, and they actually ticked down when we compare the regional banking ETF to the financial sector. Looking at bonds, we were really up based on yield, which means that we were down based on price. We have now broke below the 200-day moving average. The RSI is negative, and the MACD is also negative. When we look at the value to growth ratio and compare it to the 10-year Treasury yield, we're seeing the relationship really dropping off right now, almost to a neutral point, where these have a tendency to go in the same direction and not get too far apart from each other. We're not seeing that right now. But folks are still favoring riskier bonds over more conservative bonds. We're also seeing the short-term relationship between the S&P 500 and the long-term bond ETF continue to go in opposite directions. The 50 period, which is a longer-term relationship study, is starting to roll over again, and the spread between the two did decline a little bit, but it's still quite wide. This is the chart that's also giving us some concern. We want this ratio to be going down when we look at cash and compare it to the 3 to 7 year bond ETF, but it's going up. That means that there's uncertainty about interest rates right now. We're also still above the 3-month yield, going back to where it was in 2007 before the great financial crisis. Is this a warning sign? Long term, we're still positive with the special K above the red line, but weekly, we're still below the red line. The rate of change going back 200 periods on a more intermediate to longer term basis, we are starting to look a little toppy, but when we break this out and look at a longer term chart, we could go a lot higher than where we're at right now. We just might have bumped into more intermediate term overhead resistance. An update of our possible positive scenarios. We're still positive based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. We're also showing a little bit of improvement with the Qs to the S&P, as well as discretionary to the S&P. We turned up just a little bit with large cap growth versus large cap value. The large caps showing a little bit of improvement. We're turning down with the mid caps as well as the small caps. The stocks above their 50-period moving average continues to be positive. And the mid caps also declined a little bit, but is still positive. And with the small caps, we declined a little bit, but we remain positive. The stocks above their 200-day moving average in the S&P continue to be fairly strong. When we really use this indicator is when we get an extreme positive or negative reading. Otherwise, we just say above 50 is positive, below 50 is negative. The S&P to utilities ratio declined just a little bit since utilities were up on the day, but overall this ratio is going up, which often gives good support to the S&P. When we look at the broad range of the highs minus the lows and then take a 5-period moving average, we're still above zero. And the 10-period average of the highs minus the lows in the S&P still remains extreme, but we've been camping here now for a few days, so this could suggest good momentum. The 50-period exponential moving average of the new highs, new lows continue to show some improvement. Our indicator is above zero and advancing. But this is a little concern. When we compare growth to value with the S&P 500, we are showing a decline even though we're still in an uptrend. The Staples to S&P 500 ratio ticked up just a little bit, but we've really been declining. This could give support to the S&P 500. So what's our outlook for Thursday? The technicals, they're staying positive for now. We still have some short-term overbought indications that we're working through and a few in the intermediate term. The economic reports coming out, and these have shifted a little bit. We get the weekly MBA mortgage index, the ADP employment change report, weekly jobless claims, the IHS market services PMI, the final reading, and then the big one will be the ISM non-manufacturing index, and then the job openings report will be coming out. Geopolitical events, keeping an eye on Russia, which now also includes Belarus. But as far as the market is concerned, we have inflation and interest rates, whatever growth scenario the market is currently latching on to. Here's the updated chart for the economic reports for the week. Here are the Stock Traders Almanac statistics for July 6th, where we're neutral to positive with the Dow and we're more positive with the S&P and with the NASDAQ. Here is the monthly chart where we will be on the third trading day of the month, where in a pre-election year we do see some positive action here before we move a little bit more choppy and then possibly start to hit some weakness going into the middle part of July. We're also keeping an eye on this, where the NASDAQ still tends to perform well into the middle part of July as well. So our scenarios, we can't really go with the down one right now because we have not switched negative, even though we're still short-term overbought and somewhat intermediate-term overbought. We're still going with the positive trend, but be aware that we are short-term overbought. We can't really go with the sideways trend right now because our ADX is above 20. It's also above its moving average, so we are in a strong trending environment. The warning signs. The VIX is still showing that there's a lot of complacency. It's starting to act a bit weird. That's why we're looking at that other chart. The cumulative new highs, new lows for the NASDAQ continue to show weakness. The 3-month yield is still back above where it was in 2007 before the great financial crisis happened. And then earnings season can be either positive or negative. On the positive side, we have the seasonality and setups, which I usually cover in the weekly video. Those are still in the background. The long-term daily special K chart is still positive, where the weekly chart continues to be negative. Our long-term equity put-call ratio is positive. The S&P is above the downtrend channel upper line. We're still in a risk-on posture. The transports are improving, but have we hit resistance now? Lower price levels may provide support, and so far that support has held. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100 continue to break out, but they also have overhead resistance. The NASDAQ at that 61.8% retracement level, the NASDAQ 100 at the previous high. The staples to S&P 500 ratio is still declining overall, and the small caps measured by the Russell 2000 index has generated a recent golden cross, and the mid caps also generated a recent golden cross. Small and mid cap growth continue to be positive. So our conclusion, the S&P, it remains positive, but we're still dealing with an overbought situation. In the short term, we're positive but overbought. Intermediate term, we're somewhat overbought, but we remain positive, and we're still positive in the longer term. Thank you. I hope you have a really good day, and I will talk to you in the next video.